Tom Lee, the man, the myth, the legend himself, has done it. He raised his S&P 500 price target for the first time in a long time. In fact, many of you guys might not know, but Tom Lee's price target as of yesterday was only 5,200 on the S&P. By the end of this year, which was technically forecasting a fall of about 8.5%. Take a listen to this.
Tom Lee is back with us for his latest musings on the markets. It's managing partner, head of research at Fundstrat Global Advisors, as well as a CNBC contributor. People forget, I think, but your outlook and views are always nuanced to some extent, Tom. So last time you were on, after being pretty bullish on small caps through the end of the year, I wouldn't say you didn't change that long-term view, but you did express some near-term caution. And these people want to know, the people that follow you, the people that watch Squawk Box, they want to know exactly what to do every minute of every day. So it looked to them like you had waffled on your long-term view. And you're going to say the same thing today. I think near-term, you acknowledge that there could be some bumpiness, choppiness, but by the end of the year, you think 6,000 on the S&P.
That's right. I think we're still in the midst of a very tricky period because we've got the election in less than 35 days. And now we've got two things that investors don't know how to discount. One is, mounting tensions in the Middle East, and then a port strike that is potentially going to cripple the economy. And so I think that as investors worry about this, if we get a dip, and a big dip, I think you still want to buy that dip because the setup into year end has a lot of tailwinds.
The worst case scenario for the port situation is something that we've seen. And we shut down an economy already, and that was probably a time to buy. We know that. So we've seen that movie before. Could it be? I can't imagine it could be as bad as the pandemic, but we have shut down an economy before.
Yeah, that's right. So I think it creates headline risk because, the longer this strike lasts, there'll be companies that miss, and so S&P earnings might get downgraded or some stocks might miss results. But that's all just temporary. I mean, those are just short-term headwinds because it doesn't change the long-term outlook.
It's very strange that I don't remember any war that lasts, that where the effects, and we've been through quite a few back in the 90s and in the 2000s. It never seemed to have as negative an effect on the overall markets as we thought at the beginning of each.
That's right. In fact, if we look at the last 6 sort of global wars or tensions, you almost always buy the invasion. The exception was 2022 with the Russia-Ukraine war because we were also in the midst of a Fed tightening cycle. So that was not a buy the invasion event. But the other times you did want to buy.
Both Iraq wars.
Yep, both Iraq and.
Was the market, where was the market before that happened? Had levels come down, or were they trading at near highs or at highs?
Yes, this is different because we are hovering near highs and we're in an extended market.
And things aren't cheap in terms of multiples.
That's right. But at the same time, we also know there is a lot of cash on the sidelines.
Right.
Because margin debt hasn't risen for 4 months. I mean, that's pretty unusual with a rising stock market. And now money market cash has actually been rising at a time when the Fed is cutting. So I do think there's firepower.
The other issue, just the longshoreman strike, if that goes on for an extended period of time, is that something, we were talking before how much that cuts off the GDP. If it's there for a week, maybe cuts 0.3 of the GDP.
Yeah.
For every week they're out. Is that something that the Fed comes in with much more aggressive cuts and that fixes things, or are there inflationary factors that also come into play and that ties their hands?
The Fed has to kind of put that in their calculus because the labor market has also softened. So if this is a shock in a way that causes the labor market to weaken, the Fed's going to be a lot more dovish. But we get the payrolls report Friday, and I'd say maybe it sort of early hints seem like it's actually going to be a better than expected report.
But then you also add in what would happen from inflationary pressures, not only from the longshoreman strike, but potentially from oil prices going up in the Middle East, too.
Yeah, that's right. I think the Fed at this point would be more concerned if the consumer expectations got unanchored on inflation, and those have actually been improving. So I think the Fed can be less worried about the inflation side of it.
Did you see Tepper talking about China? Would you ever
subscribe to that theory?
Buy a lot in China?
Yeah, I mean, I'd say that not only did China launch a bazooka, but it's really working, right? Because the stock market has really broken out. I think China is now the best performing stock market this year.
But was the move made? I mean, I think, we had Kyle Bass on yesterday, and I think he would argue long term, no matter how you want to think about China, it's a bad bet. He was suggesting maybe in the short term, it's a good bet. And I don't think he was necessarily opining on whether the bet is over. But the move, obviously, the big move has happened. The question is, do you see that doubling? Is that in the cards at this point of the game?
Yeah, I mean, something to keep in people's back of their mind. Over the last 10 years, China has underperformed the U.S. by 7,700 basis points. So if China doubles, it's still underperformed by like 5,000 basis points. So, I mean, there's a lot of room for a rally, even if it looks corrective.
I think his phrase was something like, it's just a bad bet on communists.
He's saying long term it's a bad bet, but he's saying short term it might be a good bet.
It's not our grandfather's communism. It's almost, I don't even know we need a portmanteau for what capitalism, based with communism is.
Yeah.
Bidenomics, maybe. Kidding, Andrew. Kidding.
Ouch! Did anyone hear that slick shot thrown at the Biden administration? Woo, that was a nasty little side comment there. But this was, let's acknowledge, a seemingly cautious Tom Lee. He basically says in the near term, there could be a lot of problems with this port strike, with the upcoming election, the uncertainty around this. One thing I wish was highlighted more that Tom Lee's kind of stayed away from is the overall economy, is more in depth about the labor market. Yes, Tom Lee said this Friday's jobs report looks like it's going to be on the stronger side, but he hasn't really commented on the economy, on a soft landing, on some of the maybe problem areas we're seeing in the economy in a while. So it just seems obvious to me, someone that has followed Tom Lee for many years. After all, he grew up in Michigan. I'm filming this video in Michigan. I'm born and raised in Michigan. A lot of you guys probably did not know that. Yes, Tom Lee is from Michigan. It's kind of starting to stand out to me at this point. Nonetheless, Tom Lee says by the end of this year, once the election is over, once you get more clarity on potentially the Middle East situation, how bad that's going to get, once you clear up the longshore strike on the East Coast from Maine to Texas, they're currently striking, then there's going to be more tailwinds for this economy. I mean, I think it's a little bit simpler than that. If you really want to boil this down, markets will do good if the economy does good. One thing that I found problematic, Tom Lee started to mention, is a downgrading cycle of EPS earnings for the S&P 500, even in the near term. Okay, the reason why buying and holding stocks long term is so successful is because Wall Street does not look out that far. Like, we might think Wall Street cares about long term, like a company XYZ may be doing bad now, but it's going to grow exponentially longer term. Wall Street doesn't care about that. If they did, Tesla would be much higher than where it is today. Think about Tesla's robotaxi prospects. Eventually, they will be the top provider of robotaxi services. Eventually, okay? Could be a year from now, could be 3 years, 5 years from now. Wall Street doesn't care that much about the longer term. Wall Street seems to focus on the next 1 to 3 quarters more than anything else. And if we do go through a cycle downgrade of EPS estimates for 2025, markets are not prepared for that. The reason why markets are near all-time highs still is because EPS estimates are almost 20% for next year, meaning markets are expecting 20% EPS growth from 2024 through 2025. If the economy weakens, if this strike is prolonged and disrupts supply chains and impacts companies and businesses, those estimates are going to come down And markets are not priced for that. Now, yes, to Tom Lee's point, he mentioned that this Friday's non-farm payrolls look like they could be a little bit better than previously expected. The ADP employment change came in this morning. This is the private payroll number that we get from the ADP. And it always comes in before non-farm payrolls. It doesn't tend to have too much correlation in non-farms. Keep that in mind. But Wall Street likes to look at this and try to judge what that means for non-farms that typically come out about 2 days later. Nonetheless, the estimate today was 120,000. We came in at 143,000 job ads. So the headline number was better than expected. But David Rosenberg on X says this: the bond market doesn't seem to have figured out yet that in raw, non-seasonally adjusted terms, ADP employment plunged negative 260,000, which was an unprecedented decline for any September since the series began in 2010. Fishy? And really what that's saying, if you just look at the raw numbers, you were actually negative 260,000. And then they add these seasonal adjustments in, basically like an upwards revision, and you were insanely positive, right? You came in better than expected. But exclude that seasonal revision, which is really just an average of what we've done historically, then you were actually really, really bad for last month. Now, I just screenshotted this post from Facebook. I've seen a couple of posts like this on Facebook and circulating on X from average people. It says, as a rapid job quitter, I'm telling y'all right now, this is not a quitting economy. Like, there is clearly weakness in the labor market. There is clearly struggles that are being had when average people are trying to get jobs. We're hearing about this in our personal lives, but it's not being reflected in the economic data yet. Again, this is one of those anecdotal signs, like, I mean, that things are worse than the economic data that we are getting actually suggest. Eventually, this will start to catch up to markets here. And we will start to see that reflected in the data. But as I've said here on this channel many of times, I don't think you're going to see bad economic data, at least, not really bad economic data, before the election. That's why I'm more concerned about November, specifically concerned about December, January, February, and March of 2025. That's where I think you want to have a lot of dry powder on the sidelines, ready to buy the dip. Because again, like I said, there's so many different risk factors out here that could affect EPS, estimates for 2025, and markets are not priced for that. In other words, you don't need to see a recession to get massive downside from here in markets. Just like 2022, if recession fears grow, if this strike lasts a while and causes fear and uncertainty in markets, and maybe analysts start revising down 2025 EPS estimates, then you're going to see valuations take a hit based on that. You could see a 15 to 20% decline in markets, again, without seeing an actual recession, just as things start to slow down, because markets right now are, unfortunately, a lot of people don't want to hear this, they are priced for perfection. Even with Tom Lee's target today, I mean, from current prices, considering we've fallen a little bit from all-time highs, to get to 6,000 on the S&P, is only 5.5% upside. Okay, if things go wrong from here, you're looking at substantially more downside than 5.5%. Like 5.5% downside would put you back to like 537. I think that could happen with, just a little bit more uncertainty in the Middle East. If this strike lasts a couple more days, it's not going to take a lot to get down 5.5% from here, given how high we are and how much we've rallied recently. To get back to your August 5th lows would be 10.5% downside. Like, the risk to reward just doesn't make a whole lot of logical sense right now, especially heading into Q3 earnings, in which we're starting to get more and more disappointments. Look at Nike. Look at Darden Restaurants. Look at FedEx. These are better gauges than economic data to what's actually happening in the economy. And they're not telling us great things. Look at Stellantis. Their deliveries are down 20% year over year. This article from CNBC says Stellantis U.S. auto sales extend free fall in the third quarter, with a 19.8% decline in Q3 versus Q3 of 2023. Now, GM did fare better, but their deliveries were still down 2% from Q3 2023 versus Q3 of 2024. Here on the day today, almost all of your major indexes are in the red. The Nasdaq's barely holding on to a positive gain, up 0.02% today, but there's really not a clear underperformer. Everything's just kind of down like 0.1%. It's not really a terrible day considering the ADP employment change came in really good. I'm actually quite surprised by the lack of performance today in markets. You can see 10-year treasury yields are up 4.5 basis points today. This could have something to do with it because, lending is getting a little bit tighter, and has gotten quite a bit tighter since the Fed cut rates 50 basis points. 10-year treasury yields now up to 3.78% from that low of 3.62%, so up 16 basis points since the Fed cut rates 50 basis points, which is kind of insane that, bonds have sold off the way they have. People have not bought bonds following the Fed's aggressive first rate cut. The latest AI investor sentiment survey shows bullish investors at 49.6%, neutral investors at 26.7%, and bearish investors at 23.7%. The percent of stocks currently trading above their 50-day moving average today is up to 58.36%. That's actually a rise of 0.68%. So 0.68% of stocks are breaking above their 50-day moving average. So it's definitely not a terrible day, but it's not like a really good day either. CNN's Fear and Greed Index is unchanged from yesterday. Yesterday, you closed the day at 69, which is on the higher end range of greed. And today, you are at 69, which is unchanged. And look at this. Goldman Sachs trading desk, Rubner says, quote, "I am bullish on U.S. equities for a year-end rally starting on October 28th. I am worried that my 6,000 target is too low." And this is basically what they are expecting. Some choppiness. They're expecting markets will ultimately bottom in the first couple of days of October, rally from there, fall again heading into the election, or really the end of October. And then heading into the election, markets will rally. And this is historically what happens. And then you get a really aggressive end of the year rally, which again is certainly possible. And I would not necessarily bet against that at this point. But I do think the higher we go, the more unreasonable this market becomes. Because imagine this, if everything goes off without a hitch, if there's no larger conflict in the Middle East, great. If there's no, sticky inflation, great. If the Fed is able to methodically and slowly cut rates, great. If the markets actually rebound and can, get some strength, and not stocks, but the marketplace, the economy can rebound and catch some strength. There's no more weakening in the economy. Great. The problem is markets are priced for these things. Even if that happens, you're priced for that. It's like Nvidia rallying 50% heading into earnings. Even if they give you better than expected results, the odds of the stock going up further from there are much lower than Nvidia selling off 50% into much better results. So for anyone that's been in the markets for a long time, you understand the problem with markets right now. Again, even if things go off without a hitch throughout all of 2025, no recession, no geopolitical tensions, things just are kosher and we're good. Nothing dramatic or bad happens. There's no more weakening in the economy. We're priced for that. So really, to get exponential upside here, you need to see earnings come in at like 25% positive year-over-year growth. I don't know what the catalyst is to give us that. The only thing that makes sense to me is if people are able to start selling their homes, buying new homes, taking that equity out of their homes, pulling that to their bank accounts via selling their home, and then able to spend that out in the economy. That's the only upside surprise I can really see to economic activity right now. Anything else just sounds like wishful thinking. Whereas, again, if the economy continues to slow, which is the trajectory we're on, if tensions in the Middle East do grow, which looks like the trajectory we are on, if we do see the Fed that has to, cut rates more aggressive potentially to help out this economy. All of those things historically lead to negative markets in the near term. And it looks like the pace in which things are not really getting better, right? They're getting worse. Now, there was that welcome news with the JOLTS job openings, but then if you look at the quits rate, like this post suggests, people are not really quitting jobs anymore. The hiring rate is also falling, something you really don't see minus recession. And you can see that here, the hires rate in blue and the quits rate in green. They are both plummeting, which tends to happen only during recessions. And if any of these more negative things happen in the economy, if this strike lasts a while, so on and so forth, we're not priced for that. Markets are not priced for that. Now, if markets were down 20% from all-time highs, I would say even if we meet expectations or the economy doesn't quite grow as much as we're expecting, perhaps if EPS estimates came in at 15% positive year over year, that would be enough to give you some upside. But not with where markets are priced right now and expectations. Now, tomorrow morning, we are going to get initial jobless claims. Markets are expecting around 220,000. Last week was 218,000. So that'll be a pretty decent size catalyst coming out at 8:30 in the morning tomorrow. At 7:30 in the morning tomorrow, you will get challenger job cuts. Now, this made the headlines a lot last month because this was like 170% rise in challenger job cuts. On a month over month basis, right? You went up a lot on a month over month basis. Now, you normally only really see this after the holiday shopping season, okay? Look at September 2023, right? You kind of trend lower into December because people are not scheduling as many job cuts in the holiday season. But then you tend to get that seasonal job cut in January, February, March. And then you tend to trend lower again. And you tend to continue to trend low heading into the holiday season. So you tend to get that spike in January, February, March, and then it winds down from there in the early summer months. Last month was a surprising jump higher in the expected amount of job cuts. Now, what this really is people that are getting like warn notices, people that are getting layoff notices, like, hey, prepared to be laid off in the next month or so. That spiked a lot in August. If it spikes further in September, that's a big problem because that means there's not going to be as much seasonal hiring as potentially we thought. And that is something Wall Street will be paying very close attention to coming tomorrow morning. Now, tomorrow's big data is the ISM services PMIs. We're expecting that at 51.7. As long as we're above 50, I think that's good. If we come in higher, that's also good because, services have been positive. Manufacturing's been negative for years, right? So if you see services start to go negative, then that's going to bring up more fears about the economy. You will get services employment, services new orders, services prices, and business activity. So all of that will be important. And then you get Fed Bostic that speaks around 10:30 a.m. tomorrow. The Fed balance sheet comes out at about 4:30 p.m. And then you head into Friday's big data, which is non-farm payrolls, expecting 140,000 job ads now, and the unemployment rate, which is expected to stay steady at 4.2%. There doesn't seem to be any escalations today in the Middle East besides kind of the normal stuff we've been dealing with. If Israel does launch an attack on Iran, that's where things will escalate further. So we'll have to see if that happens. If that does happen, I would expect markets are going to get a little bit more fearful. Gold's going to catch an even larger bid. Oil is going to catch a bid. And that's not exactly great for markets. Markets don't know how to deal with geopolitical tensions or conflict as well as you might think. It's kind of out of the market's ballpark. We look at companies, we look at cash flow and balance sheets. Geopolitical tensions kind of hard for markets to digest. So we will see what happens. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.